Okay, so Bismillahirrahmanirrahim, we continue this lecture. So, the very important paper is by Gode and Sundar. Both of them are Indian economists. Allocative efficiency of markets with zero intelligence traders. Markets as a partial substitute for individual rationality. So this is a paper that I want to cover, and basically what he asks is, what the authors ask is, what will happen, will we get convergence if we have a market in which the traders have no intelligence? So how do they do that? Well, they do that by simulation. They create computer agents. These are called agents actually. So these are just computer programs. Having real human beings, you have bidding. You have computers. Computers are given these assets exactly like in the oral double option. Told the rules of the game. The programs just do their bidding according to certain rules, which we will discuss. And so they ask, will convergence happen? So very surprisingly, these zero intelligence agents also converge. So this is very surprising because we believe that the convergence to equilibrium happens because the agents are doing some learning. But these agents, these computer agents, they have no learning ability, they have no memory. They just follow very simple rules. There is only one rule that is needed, that's called the no loss. So if you are a seller and you have a cost, then you can make a random ask, but it cannot be below your cost. And similarly for the buyer, you can make any random bid that you like, as long as it's below your value. So you should, and just by following these two rules, you get convergence. This is really a surprising thing. And so the question, so what they say is that it's the market structure which leads to convergence. It doesn't have to do with individual rationality. It doesn't have to do with optimization. So this is now their conclusion, as it turns out, is wrong. But this is very famous, very widely believed, and this is currently the dominant paradigm. Understanding among economists is that intelligence is not required, the market works by magic. So here is the paper briefly summarized here. Alright, so this is the situation, this is the demand and supply curve. You understand this hopefully. There is one agent who has cost of 70, one agent who has cost of 80, this is the supply curve, one agent who has cost of 90, one agent who has cost of 100. Oh, I think this is going in steps of 5 or maybe 1. It's going from 80 to 100. So anyway, these are your seller costs. There are 6 sellers and 6 buyers. So this is the supply curve, the demand curve is over here. The section step which is occurring at the equilibrium price. So at the equilibrium price you have exactly the same number of sellers as buyers. So now in the first step, just for a benchmark, he said, okay, let the traders sell without any constraints. So this is completely random bidding. They don't even look at their own costs. So they can sometimes make trade at a loss. So you can see that the outcomes are completely random. They go from the bottom to the top and they fluctuate wildly, and there is no learning and there is no pattern. The people are just randomly bidding. It has no relation to their cost. Some people are selling at a loss, some people are buying at a loss, and so on. So there is no pattern. But this is just the bench line, the baseline. Now in the second picture, this is, so the first one is ZI for zero intelligence, U unconstrained. Now this is ZIC, zero intelligence but constrained to make no losses. Now strangely enough, the wild fluctuations go away. the sellers, you see, it has to stay within the supply and demand graph, because the seller has to make an offer above that, and he can make a very high offer, but the buyer will not accept, because the buyer is also constrained to make a bid under it. So the only transaction that can take place is within that triangle, where the seller's cost is met and the buyer's value is also met. So you can see that now the fluctuations are much, much less. You can't really see it clearly, but the convergence is occurring within a round. That is, in one round, at the beginning there is more variation, and towards the end there is less variation. It's not very clearly visible. The other thing which is not happening is that there is no learning from one period to the next. This is something humans are very good at. In the one period they play the game, in the second period the pattern is very different, because they know what happened in the previous game. In this one there is no such pattern. All of the periods are exactly the same, because zero intelligence, there is no learning. So that's to be expected. Now here is the picture with the human traders. You can see there is a little bit of fluctuation in the first period and a little bit of fluctuation in the second period, but after that in third, fourth, fifth, sixth period you have direct maximum convergence to equilibrium basically. So learning is taking place. So humans are definitely learning, and humans are different from zero intelligence. So when you play with your subjects you will find out how much difference there is. But so there is still a mystery. Why does convergence to equilibrium occur with ZIC agents? So there are many different types of markets that they examine, Gord and Sundar. Here is a different market in which the supply curve is very sharp, very close to the equilibrium. You have a lot of traders, so you might be able, the mistakes are more likely. But still, if you look at the top picture, that's the ZIC traders, and if you look at it, you can see convergence, that is within one round. Initially you have more fluctuations, and towards the end you have something which is close to equilibrium. But for human traders, in the first round you have very rapid convergence, and then in all subsequent rounds there is perfect convergence, except for this one sharp dip which occurred due to, this was a computerized thing, and there was a wrong bid and mistake made by one of the traders in submitting the bid, which led to this disequilibrium outcome. So what we learned from this experiment, conducted both on humans and run on a computer, is that the ZIU has no convergence, ZIC has convergence to equilibrium within a round like humans, but not across, and humans have very rapid convergence across rounds and also convergence within one round. So we learn that convergence to equilibrium within one round is driven by the structure of the oral double auction. It doesn't have to do with learning. This is contrary to the SND idea. The SND says that human beings, intelligent actions to profit maximize lead to convergence. So within the ODA this is not true, at least in one round. In multiple rounds it is true that there is learning, but then now the question that we want to ask is, what is the nature of this learning? And this is an issue on which there is a huge amount of literature. And as I will explain, most of it is misguided. They are looking in the wrong direction about learning. And so we can conduct better experiments with better understanding of learning, and we can, this would be state-of-the-art, borderline and cutting-edge research. So now we have to understand convergence. So there are multiple levels of modeling going on. First of all, our oral double auction is itself a model for the real world, and now trying to think of the oral double auction as our reality. And now we want to make a model to explain what happens in the oral double auction. So you conduct this artificial experiment and then you ask, why do we get convergence? So now we have to build a model for this to explain. And this is what the process is. That what is a model? Model tries to understand the hidden reality. So there is a hidden reality. There is some behavior that the human beings are doing. What is that behavior? We don't know, because we don't know how they make their decisions. So I make a very simple model, which is the zero intelligence model. And I say, okay, people just make random bids above their cost. For sellers, they make random asks above their cost. Buyers make random bids below their value. So then what will happen in such a market? So we find that now we compare the results of our model with the reality of the ODA, and we see that there is something that the ZIC agents are doing, which is they are converging. So we see that humans are learning across rounds, but maybe convergence in a round is governed by some other factors we don't understand as yet. Why does it happen? It's certainly not learning and certainly not profit maximization. So the summary of good is that ZIC agents show higher volatility than humans, but less than pure random. So there the constraints control the volatility. There is convergence to equilibrium within rounds, and there is high efficiency. That is, most of the surplus is obtained. And the conclusion is that convergence and efficiency in a round does not depend upon optimization. Now there is a paper written in 1998 by Dave Cliff and Janet Bruton at MIT Artificial Intelligence Labs. And the paper's title is Zero is Not Enough, and they say that, well, the Goth and Cinder results are wrong. They get their results because of the particular choice that they made in supply and demand. And if the supply and demand curves are shaped in a different way, then they would not have gotten convergence. Now, they are correct that the Goth and Cinder results are not correct, but they are wrong about their reason for their failure. I was going to explain this paper in detail, but now that was my lecture going to be, but now I've abandoned it. So we will just go on to the correct explanation, which is in a paper by Charlie Plott, who was my colleague at Caltech. So basically the explanation for the convergence in the Gould-Sundar experiments is the Marshallian path. The Marshallian path is that, suppose that we have full information, everybody knows everything. So what will happen in this game? The first thing, basically the buyer, the seller with the lowest cost is the most advantaged, and the buyer with the highest value is the most advantaged. And under many rules, many types of rules, what will happen is that this will be the first pair to trade. So suppose that we have cost going from 1 to 10 and buyer's value is also going from 1 to 10, as we have done in the experiment. Then the buyer with cost 1, the seller with cost 1 will trade with the buyer with cost value 10. And so in the first transaction, these two will go out of the market. And so the initial price, which could be anything in between, depending on how these people negotiate, but the range of the first transaction will be between 1 and 10. then these two are out of the market. So the second transaction will be take place between number 2 seller and number 9 buyer. So now the range will be between 2 and 9, and the third transaction will be between 3 and 8. So the range will now be between 3 and 8, and so it will keep on going. The last transaction will take place between 5 and 5, and the range will be very narrow. By the way, in these games that we play, what we do is we pay a small amount of fees for completing a transaction. This means that it has cost 5, the seller has cost 5, buyer has valued 5 also, then different as to whether or not they make the transaction, because they buy at 5 and they sell at 5, so there is no value. So what we would like to do is to make sure that these transactions take place, because we don't want one thing or the other thing. We either want to prevent all such transactions or we want to enforce them. We don't want this randomness this will cause. So what we do is we pay a small fee, like maybe 5 rupees, and they have 5 cents in the experiment. So for each completed transaction you get a small fee, but it should not be large enough to compete with the surplus that you are making in the trades themselves, but it should be non-zero to incentivize a transaction. So basically, now if this is a deterministic path, if this is exactly how the convergence takes place, then we will see convergence to equilibrium. This is how it will happen. The last transaction will always take place at 5, the second last will take place between 4 and 6, and so on. So we have convergence by the process. Now think about this process, how it happens. Every seller makes a ask, but who is going to make the best ask? Every seller makes ask between his cost and some upper bound. So who is going to make the best ask, the worst cost? This is going to be random, because it's random, sometimes this will not be the smallest, but on the average, in probability, the best offer will be made by, best ask will be made by the least. And so over multiple games, the first transaction will be taking place between number 1 seller and number 10 buyer, and so on. The second will be taking place between 2 and 10, and maybe even if the first one is skipped on the first round, sometimes it will happen, he will come in later. So the chances of 1 and 10 coming in early process are very high, and basically the last two, the ones who are almost unmatched, they will not be coming in until very late when all of the other things are exhausted. So automatically you will have convergence, and this convergence is due to the way the process is structured. So what Plot did to test, so this is a test this hypothesis, very clever. He says, okay, so the reason the convergence is happening in the zero intelligence is because as the transactions take place, both the demand curve and the supply curve change. They are not the initial ones. So when you get to the second transaction, then the bottom trader is out of the picture and the top, so the demand curve is narrower. And then again you keep changing, and ultimately the demand supply keeps shrinking. And so let's prevent this from happening. So how did they prevent this from happening? What they did was, in their experiment, they said, okay, anyone who sells a good, he gets replenished. Actually, he didn't get replenished because that would have caused some problems. But what they did was, this was a continuous time oral double auction, and it was done on a computer. So as soon as the unit which has value 1 gets sold, and the seller with cost and the buyer with the value 10 buys, so these two go out of the market. First of all, the game they had was multiple units, so everyone had many units at different prices, and the buyers had many buys at different prices. So what they did was that as soon as one unit goes out of the market, they put it back in, but they give it to somebody else. So random people are getting, okay, seller 1, you have 1 more unit to sell at cost 1. Okay, buyer 1, you should buy 1 more unit and you can get 10 rupees for it. So they randomly, the supply demand curve remains the same. after the sale, because they replenish the unit which has been sold. And now you run this experiment with ZI, and you find that there is no convergence. In fact, in this case, the supply and demand curve is the same, so the transaction within a period is exactly the same for every single one. There is no change. Now there is no learning. So you understand that the Gold-Sunder results are misleading. They suggest that you have convergence, but in fact the convergence is due to the mechanics of the thing which shifts the supply and demand and makes it. So I initially asked Maaz to program this in NetLogo, and but what I did was I didn't understand at that time that this like the reason for convergence. I had read this clip, but I hadn't read the plot paper. So what I did in that program was that, okay, I programmed these traders and they had to learn, but what I said, okay, take your group of sellers and pick one seller at random from this group. So now, and then pick a buyer at random, and then we allow them to trade. Now this one is not going to work like the this one doesn't give an edge to the least cost seller, because maybe we pick the highest cost seller. So if I want to achieve convergence advantage, then I have to run the system the other way. The other way to set this up is, which I have asked him to program this time, is that everyone makes a bid, everyone makes a sealed bid. The buyers, everyone makes a sealed bid to buy. The sellers, everyone makes a sealed to sell. Now I look at all of these offers and I pick the best bid. And I look at all of the sellers and I pick the best ask. And then I say, okay, you guys can bid. So in that case, if I do this second procedure, this is now I'm talking about microstructure. If I do this second, then the least cost seller is advantaged, and then you will get convergence. If I do the first procedure, you will still get convergence, but it will be very much slower, because now there is still an advantage to the least cost in that his ask will be better, but they will come much later. So there will be a lot more fluctuation, and so the difference between the two structures, I mean, this is what you have to understand as experimentalists. In the choose a seller at random and I choose a buyer at random, negotiate with each other, then the last seller is not advantaged. Most valued seller is not advantaged. So a lot of disjunct transactions will take place. Suppose somebody who has cost 8, and from this accident I pick somebody who has value 9 or 10. They will succeed in completing a transaction. Now in oral double auction, at least in nobody knows who has the advantage. We don't know what other costs are. So the person who shouts can be easily the high cost one or the low cost one. So at least in the initial rounds, the idea of choosing someone at random matches what's actually happening in real world double auctions. But as rounds progress and some information is gained about the price, then change, because learning is taking place. So this setup, the second setup is much more likely to lead to convergence. Now another program, another game which I was going to play, which we don't have time, which will also has the property that the least cost is not advantaged and the most value is not advantaged, and so convergence will not take place. And this is the case where of the buyers have the value and all of this has exactly the same cost. This is called setup. The one. You see, all of the sellers have exactly the same cost, then the cost is vertical. So there is a fixed number of sellers. Suppose that the sellers are in number. So every seller has the same cost, which is the flat line, and then more than 5 you can't buy at any price because there is only 5 units. And buyers have the same, all the same value, and then there is a fixed number. Now suppose that the number is larger as in this picture, so you have more buyers. So what will happen in this game? What will happen in this game in any double auction is that this is very important to discovery that there is excess buyers will not take place until the end, right? Because as long as in this game, if you see, okay, we can look at this is an illustration S&D theory. This illustrates precisely what S&D theory is about. That there is excess demand. What should happen theoretically is that the intersection edge is at the demand. The demanders will get no surplus. That's what the theory says. But actually, according to the microstructure, we will, in the first game, we will get a random, we will get an equal split. Because nobody knows. The sellers don't know if they are, and the buyers don't know. So we will get a midpoints this game. So we can actually see what happens. This is the illustration. If you look at this is the box diagram. The first week is the first panel, and you see in the first panel the prices are in the middle of the supply price and the convergence in the first round. Can you see that? That's the first panel. Now in the second panel, we find out that there is excess demand. Prices are going up. Why do we find out? Actually, everybody finds out. It's those people who failed to be able to buy. They had a chance to buy. They saw that the price. Let's say that the price in the market is around 50. If I had purchased this for 50, I could have sold, but I wasn't able to purchase. Now in the next round, these people, the ones who were frustrated, they are going to bid higher because they can't get the buy. So second round, this is how learning is. Those buyers who were burnt, they will be offering more, and you see convergence. In the third round, you start to get convergence toward the end. In the fourth round, you have pretty good. You have convergence. What the expert does is he switches the supply and demand. After the fifth week, you have excess supply instead of demand. But nobody knows, because when you have multiple units, you see the way in the experiment, I know the number of suppliers and buyers, so you can see how many suppliers. But if you have multiple units, you don't know who has how many units. Actually, in a computer, you know the number. So now, in this week, even in the sixth week, the prices go down. I don't know why, I don't know how. But in seventh week, they started to go down a lot, and ultimate 10th week, they converge equilibrium price. Learning takes place. We are going to program this. We would say is that behavior. Second round will be different. For those agents, the learning mechanism who couldn't make a sale will be different from. They will be more aggressive. So there is one who will be aggressive, and the ones who are happy with what happened last time. So they will learning behavior. So more material to cover, but we have run out of time. So we will cover that next time. And if I would run this type of an experiment, if you will give me an hour later on, then we can do that.